Welcome to The Explainer. Grab your coffee because today we are rolling up our sleeves and stepping directly into the shoes of fundamental sell-side equity analysts. Before you can even think about building out a rigorous discounted cash flow model or forecasting terminal growth rates for SoFi Technologies, you've absolutely got to understand the reality of their underlying business. We are going strictly by the book today, using the latest financial filings, investor presentations, and independent research to break down SoFi's Q1 2026 performance. We're stripping away all the market noise to look at the exact products, services, and operating segments driving this company. That way, you can ground every single one of your valuation assumptions in fundamental, undeniable reality. Here is our roadmap for today. First, we'll look at their core business and products. Second, we're tracking their revenue and profit growth. Third, we're popping the hood on the balance sheet and funding. And finally, we'll wrap up with a reality check on industry risks and headwinds. All right, let's dive right into Section 1, SoFi's core business and their strategy for 2026. Okay, so in 2026, SoFi is completely expanding its identity. They are officially rolling out a new unified enterprise brand, appropriately called SoFi Technology Solutions. So they aren't just that consumer app on your phone anymore. They are aggressively targeting B2B enterprise clients. Now, this is a crucial evolution to model out because it diversifies their revenue streams away from pure consumer lending and into highly scalable, recurring enterprise fees. This new B2B suite, it's built specifically around 4 core platform businesses. We've got processing, banking core ledgers and services, payment hub, and risk and fraud. By structuring the business this way, SoFi is effectively positioning itself as the essential technological plumbing for other financial institutions and enterprise clients. When you're evaluating their competitive position, this is a massive moat. They are literally monetizing the exact same back-end infrastructure that powers their own wildly successful consumer banking operations. Now, this is huge for your forecast periods. Independent analysis from the Henry Fund reveals a crucial point. You really shouldn't just be plugging arbitrary revenue growth rates into your spreadsheets. The Henry Fund points out that SoFi's technology and financial services scale organically based on yield per user. For instance, they noted a 221% yield driver for the technology platform based on total accounts, and over 1,000% yield for financial services scaling with total members. These yield-based drivers allow revenue to scale naturally with SoFi's core operating metrics. It creates a highly defensible, incredibly transparent forecast for your discounted cash flow models. Moving on to Section 2, let's look at the actual revenue and profit growth, the upward trajectory. Let me give you the bottom line right up front. The execution here is just undeniable. In the first quarter of 2026, SoFi posted a massive, record-breaking $1.1 billion in GAAP net revenue. To be precise, the filings show $1,100,368,000. For anyone tracking the historical performance of fintechs that are transitioning into traditional banking structures, crossing that billion-dollar quarterly revenue threshold is a monumental milestone of scale. And to put that growth into perspective, look at adjusted net revenue jumping to $1,087 million for Q1 2026. If you trace that all the way back to 2022, we're talking about a 38% compound annual growth rate. 38%! That's not a flash in the pan, that is durable compounding growth. You'll also notice from the filings how the non-lending segments are contributing more and more significantly to the overall pie, really proving out that diversified business model we were just talking about. But here's the kicker. How does all this top-line explosion actually scale to the bottom line, which, as analysts, is exactly what we need to figure out our free cash flow derivations. Watch as they pivot from a massive $320 million net loss in 2022 to a $167 million adjusted net income profit in just the first quarter of 2026 alone. GAAP net income for the quarter actually came in at $166.7 million, which is up a staggering 134% from the prior year period. Management's automation and productivity initiatives are very clearly showing up right there in the margin expansion. All right, Section 3. Let's pop the hood and look at the balance sheet and funding, the real engine room. So, straight from the Q1 balance sheet, here is the breakdown of their massive loan book. It's heavily concentrated in personal and student loans. Personal loans, held for sale at fair value, sit at over $23.6 billion. Student loans, held for investment, make up over $15.3 billion. Home loans are actually a much smaller piece of the pie at $1.6 billion. Altogether, total loans cross the $42 billion mark. When you're assessing their risk profile and projecting net interest income, this specific asset mix is absolutely your primary variable. Now, to support that massive loan book, we have to look at how they build true operational stability on the liability side. And this is amazing. A staggering 96% of their funding base is now driven by member deposits. This is a dramatic structural shift. Just a few years ago, that number was sitting at 78%, with a heavy reliance on volatile outside warehouse facilities and securitizations. This shift completely reshapes their cost of capital. That 96%, that represents over $40.2 billion in actual high-quality deposits. So what does this mean when you're building your fundamental valuation? It means SoFi isn't chained to expensive, volatile outside funding to maintain their net interest margins anymore. By operating as a regulated bank holding company and driving direct deposit capture, they've secured a low-cost, incredibly sticky funding base. And this translates directly to higher, more predictable net interest income, which, by the way, hit $500 million this quarter alone. Finally, let's hit Section 4, Industry Risks and Headwinds. It's time for a reality check. Because let's be real, no model is complete without assessing the downside. According to independent research from the Henry Fund, SoFi faces 3 distinct headwinds. First up is valuation risk. The stock historically commands a premium multiple, and that leaves very, very limited room for error if growth or profitability suddenly moderates. Second is loan default risk. While SoFi targets higher FICO borrowers, a severe downturn in the labor market could rapidly increase default rates on that $42 billion loan book we just looked at. And finally, fintech and TradFi competition. SoFi is operating in an incredibly crowded space. Rivals are fiercely competing on digital user experience and product innovation, which means SoFi has to continuously deploy heavy capital expenditures just to defend its market share. And management themselves aren't hiding from the macro environment either. They explicitly call out in their forward-looking statements that they are vulnerable to fluctuating inflation, potential tariff impacts, and just the sheer heavy compliance burden of operating as a regulated bank holding company. When you are estimating your cost of equity using CAPM, these specific macroeconomic and regulatory uncertainties absolutely need to be reflected in your equity risk premium. Which leaves us with the ultimate question for your fundamental valuation. You've seen the undeniable execution, right? The record $1.1 billion quarter, the successful launch of the B2B tech platform, the $40 billion deposit mode. But when you contrast all of that against those looming macro risks and fierce competition, has the market already priced in a perfect future? You now have the product lifecycle data, the balance sheet realities, and the segment margins directly from the filings. It's time to open up your spreadsheets and let the math tell the story.